But the point behind this ICQ is to show us how would you deal with if there was no or if there was commercial substance. The good news is both IFRS and ASPE are exactly the same, so we're gonna deal with this, and it's the same answer under ASPE or IFRS. Okay, so let's start with part A. It says assuming there's commercial substance, and of course part B says what if there's no commercial substance. All right, so part A, it says with commercial substance. So what we need to do is we know we're going to look at it from Stacy's perspective first, and then we're going to look at the other company's perspective, right? So Stacy has an equipment that has a net book value of 50 minus 31,250. So the net book value is 50 minus 31,250. That gives us 18,750. And the fair value is 25,000. This is the old. So we have a gain of 6,250. Okay? So first, the way I normally do this is I always get rid of the old equipment first. Okay? So I'm gonna credit the equipment. I'm gonna say credit equipment old. And then I'm gonna debit accum depreciation. I'm gonna put the word old. Okay. Now, Stacy paid cash, right? It says that Stacy paid cash. I need to credit 3,000, right? So this is how I normally do this type of transaction because I want to make sure, first I calculate the gain or loss, and then I do the journal entry based on the information that I know, right? So I'm going to credit cash, 3,000, and then I'm going to credit the gain, that's 6,250, and then I'm going to debit the new equipment, so equipment new, and that's going to be the fair value of what Stacy gave up, right? Which is 50 and 25, sorry, plus the cash. Okay? So always record the fair value of what you gave up, then the cash. Now, you want to double check that this number cannot exceed the fair value of what you just received. You received an asset from Chokra that is, that is exactly 28,000. So there's no fair value ceiling test. So in other words, if the fair value was, let's say, 27.5, then you can't record the new asset at 28, which is what you had to add the fair value of what you gave up plus the cash. So you're gonna have to write this down to 27.5, and that means that your gain is gonna be $500 less. That's how the fair value ceiling test applies. Okay? Make sense? Now, what about Shokar? What would they do in this case, you guys? So Shokar, I would actually calculate the gain or loss as well, right? So the fair value of the old was 28,000, and the carrying value of the old was your cost less accum, and that gives me 23,000. So I have a gain of, I have a loss of 5. Okay, so again, I always start with the credit of the old. And I'm gonna debit a cum. I'm gonna debit cash, because how much cash did I receive? 3,000. Okay, and I'm going to debit the equipment new, and that's the fair value of the old less the cash, right? So that's gonna be a -3. And then I'm gonna debit the loss. So when I add them up, if I get my debits equal to credit, most likely I'm good, but then I need to check the fair value. So I'm recording 25,000 of an asset that I received from Stacy. What is the fair value of Stacy's asset? 25, so I'm good. If that number is not the same, then I need to adjust it. Now, if that number is like 28, then I'm okay. Right? Recording the asset at 25 is okay. But if the fair value is lower, then it's not okay. Does that make sense, you guys? All right? So you don't create a gain if the fair value of the asset you receive is higher than what you're recording, right? That's just the way it is. You got a bargain. You're gonna pick that up on the gain or loss when you eventually use up the asset and sell it, right? Okay, does that make sense, you guys? I just wanted to we ended the lecture last week with that. I wanted to make sure that we refocus on this fair value non-monetary exchange. Now remember, you guys, I talked about this as well on the non-monetary exchange of goods and services, and we did that in chapter 6, right? Remember the example was we gave up a bunch of vacation packages for radio ads, right? And then you have to figure out how to record that stuff. Okay. Now let's go back to part B. Is now it's without commercial substance. So without commercial substance, we know that we got to record the new equipment based on the book value of the old, right? So Stacy would record it as follows. It would credit equipment old. We're going to debit a Q old. Okay. We're going to credit cash. And the debit to new equipment new is going to be the book value of the old right, plus the cash, right? And that gives me 21,750, and that's okay, because that's going to be lower, right, than the 28. So that one I don't adjust. Okay? And on Shokar's books, we're going to do exactly the same. I'm going to credit equipment old, and that would be 55,000. I'm going to debit a Q old, 22,000. I'm going to debit cash, 3,000. I'm going to debit new equipment. That would be the carrying value of the old, okay, which is 55 minus 22, right, which is what, 33? and then I'm gonna subtract the cash. Right? That's 30. Okay? Now, we're gonna check, right? So Shakar got Stacy's asset. Stacy's only got a $25,000 asset. So we can't record the new asset at 30. We can't. Because it's more than what the fair value. So I'm gonna have to write it down. So that's where the fair value ceiling test comes in. So this has gotta be 25, because that's the fair value, which means I'm gonna have a loss, right? So I'm gonna debit a loss on exchange for 5,000. So they're gonna have to pay for that loss for whatever reason, okay? And it's not for us to question why did we do the exchange, okay? But it's for us to be able to account for the fact that the new asset can never be higher than the fair value. Now, for goods and services, there are no fair value ceiling tests. So if I'm willing to give up 10 packages, vacation packages, worth 5,000 each, that's 50,000. For your radio ad, that's only worth 40,000. That's on me. Right? Okay? Are we good? Yeah. So I want to just make sure we circle back to this question, you guys. Okay? I think it's terribly important for that. Okay, and that's kind of where we're at, right? So we did all that, okay? And then we talked about contribution of asset, you guys. So this one here is if someone gives you either a grant or a forgivable loan, or somebody gave you a free asset. And oftentimes there are a lot of institutions that will do that to encourage you to either set up a business in a remote area, for example, or they ask you to hire a bunch of, university students for co-op, and the government provides incentives for a company to do that, right? So this is kind of what we're at, okay? And there are two approaches depending on what type of contribution you received, okay? The first one is obviously the capital approach. This one here is only used if a shareholder donated capital to you. So how does that work, you guys? So let's say there's a business and the shareholders donate a bunch of trucks because they don't need it. It's a personal truck. They donate it to the business to help, right? Obviously run the business, okay? Or the owner of a building just decides to donate the value of the building, right? To the business. So that's a good example of donated capital. That one there, you're going to debit the asset at fair value and you're going to credit donated capital as part of shareholders' equity. Okay? If for whatever reason somebody else gives you a contribution, whether it's the government or a nonprofit organization, for example, then you want to know what are they giving you credit for? If it's for buying an equipment, then you would actually decide you're going to reduce the cost of the asset, or you're going to set up a deferred, some sort of deferred contribution, and you're going to amortize both the asset and the deferred contribution in the same manner. Or you could do what they call a reduction method, where you can just reduce directly the capital asset, the PP&E, in which you receive some sort of donation. Okay? So those are the approaches. Government assistance is a form of contributed donations. And again, these are the two options that you have, right? Okay? All right. And here's an example of that, you guys. So they receive a grant. And the grant is to upgrade a bunch of equipment to make it faster, make it more efficient. And again, this allows us to buy the equipment, and the equipment is carried at cost less the grant amount. Now, usually these grants have conditions that exist because the government just doesn't give you money, right? They usually say there are conditions attached to the grant, and at the end of the condition period, you actually get to keep the money. But if you don't meet those conditions, you have to pay us back. So the question becomes, do we record the reduction of the cost of the PP&E even though the condition is still in the future? So think about it for a minute, right? Or another way of phrasing it is, if you were to receive a grant, this is a company, and it requires us to hire a bunch of co-op students the next 5 years, and we're gonna support them by reducing their hourly rate to, let's say, $10. So if I have to pay you 12, then the government gives me 10. And they want us to hire 50 co-op students in the next 5 years. Obviously, we haven't hired any of them. We're gonna hire maybe only 5 or 6 of them so far. The question is, what do we do with the rest of those grants, right? Okay, so that's essentially the question at hand. Okay, and in that case, you guys, right, you have to record as if there's reasonable assurance that you're gonna meet those conditions. And you only reverse that in the year in which you believe you don't meet those conditions. So let's say I'm supposed to hire 50 students and I'm now in year 3, I've only hired 10. What is the likelihood that in 2 years I'm gonna hire 40? That's according to the grant, right? Or if I bought an equipment and I received the funds, okay, I'm supposed to use the equipment the next 5 years. And what is the likelihood if I'm not able to utilize that equipment because there's no demand for that equipment, for example? So those are questions you have to set up. And essentially our standard says as long as you can reasonably assess that you're meeting those conditions, then you record them, right, accordingly. Okay, so in other words, if you get a $225,000 grant from the government, you have to assume you're going to meet those conditions, and that's going to impact your depreciation year 1, year 2. Even though you have 5 years, 3 more years to go. That's the idea. You always have to make that assumption that you're going to meet it as long as there's reasonable assurance. But in year 3, if you believe the conditions are not met, then you adjust those prospectively. So in other words, don't change the depreciation the first 2 years, adjust them starting in year 3. Okay? So here's an example of the deferral method. This is really easy, you guys. It's just, you set up as a deferred revenue, and then you amortize them in the same manner as you're depreciating the asset. But this one sets up as a revenue, and then the depreciation sets up as an expense. But the net income effect is nil. Okay? Other issues: donated of land by government. If grant requires company to fulfill obligation condition, defer and take it into income in future obligations and conditions are satisfied. As long as you can satisfy them today, then you can record them. If you don't satisfy it, the conditions until a later date, then you set up a deferred revenue and recognize it as income once you know you have met those conditions. Grants or donations for incurring certain expenditures. So again, if they give you a grant to, for the next 5 years to help you decrease your operating expenses, then obviously for future expenditure, you recognize them again in the future years when you incur those expenses. Okay? Extensive disclosure is required in all cases. Now, the next few slides goes into what should we include in each of the individual asset, okay? So obviously for land, it's gonna be the land, the amount, the purchase price. But I wanna just make sure you understand that this is an important piece, okay? It's if I have a land and a building on top of the land, and I don't plan to, to move into the building. In fact, I'm gonna tear it down to build a ISO, whatever, right? Ergonomic or whatever it is, right? Environmental type of new age building. Then the cost of the purchase is all to land, and the demolition, removal of the old building goes into the land value. Why? Because remember the rules that says any cost associated with getting the land ready for its intended use is included. So that would include the demolishing of the old building and regrading the land to build a new building. Okay? But things like improvements on land and improvements on land that will diminish over time is called land improvements. Okay? So the word diminished over time is important here, right? Okay? Because if you have to replace them, like a fence, like lighting, paving, all of that are called land improvements. But if you're adding, let's say, fiber optics under the ground, oftentimes you don't improve those, right? They're supposed to last. Sewage, right? The actual pipes to bring water in from the city into your land, and to also take sewage out of your piece of property into the main line. That one there should be adding permanent value to the land. That should be included to the land. So the key here is that if you're adding something to the land that's going to add permanent value, then you're good. Add it to land. But if you add something to the land that's going to diminish its value over time, i.e. you have to replenish it, then you add it to land improvement. And that's the difference there is land improvement is depreciable asset, whereas land you don't depreciate. Okay? Oh, one thing, salvage value. So let's say you bought a piece of land, you tore down the building, you sold a bunch of bricks, right, to the building, and you earned some revenue. And you also took down trees and you sold it to a forest company or paper mill company. That one there, the revenue that you earn will be reduction of land, the value of the land. Okay? And that because it's necessary, right? Tearing down the old building and mitigating your cost and tearing down a bunch of, trees because you need to get the land ready was necessary, and that's why you're adding it to the cost of the land. Here's land improvement, you guys, right? Okay. And these ones here should be depreciated over its useful life. Okay. So there's some examples that are like driveway, walkways, parking lots, the lighting system, right? Those things changes over time. Fencing, etc. Building, again, raising the building is added to the building. And again, componentization is very important here, you guys. Okay. And of course, you also want to include in there interest cost, right? If building, right? If constructing, maybe I should say that, constructing the building. Okay, so that one there, by the way, IFRS is, right? It's a must. ASPE says it's a policy choice. So this is all about that interest cost, right? That's the part because raising a building, constructing a building takes you more than 1 year to do so. And any interest costs associated with buying, financing the construction of the building should be added to the cost of the building. Okay? Okay, so we talked about that already. Okay. Leasehold improvements, this is where you do not own the building, so you rent the premises and you do something to it, right? Like maybe, make some improvements, change the bathroom, change the marble in the lobby, right? All of that stuff. You don't own the building, but you make improvements out of it. And that's called leasehold improvements, okay? And it's always the lesser of the useful life or the lease life. And usually you take the 1 year renewal, right? The next renewal. So because oftentimes when a company leases, it's usually a 5-year lease, but they have the option to renew. The lessee, not the landlord, but the lessee usually has the option to renew. And if there's likelihood that they will renew, then you would add the renewal period as the amortization of the leasehold improvements. Okay? That makes sense? Equipment, we obviously know it's all costs necessary to get the equipment at the location and making it useful. So it includes in there obviously freight, handling charges, insurance, any type of foundation or electrical enhancement to the building, because it's attributable to the equipment, should be added to the cost of the equipment, not to the building. Okay, so if they have to upgrade the electrical panel, right, which costs like $200,000, okay, was it necessary to make the building useful? No, it was necessary to make the equipment more useful. Okay, and therefore, we should add it to the equipment. Now, why does that matter? Oftentimes, equipment has a different usefulness and different depreciation policy. Now, if you happen to, right, reinforce the foundation of, let's say, the second floor, because that's where you want to put the equipment in, the equipment's really heavy, okay? Was the extra cost to reinforce the second floor necessary for the building or for the equipment? That's kind of how you would ask that question, right? If the enhancement was necessary because to make the equipment sit on a foundation on the second floor so that it doesn't ruin, right, or doesn't vibrate, for example, then that would be part of the equipment, not the building. Okay? So that's what it is. And then it includes in there cost of the trial run for trial run for ASPE only. Okay? Because obviously, if you remember what we talked about, you guys, oftentimes the equipment is already ready. Okay? As opposed to ASPE is when the equipment, you stop capitalizing and start depreciating as soon as the equipment is actually ready for revenue productive use. If that includes the cost of doing a trial run, just do a test run, then that should be included in the cost of the equipment. Okay? But for us, we don't do that. Investment property is one that we need to look at IAS 40, you guys. And IAS 40 is basically and this is only for under IFRS. We don't have a separate section under ASPE. So ASPE, we call it PP&E, you guys, as part of that property, plant, and equipment. And here, it's all about a building or an equipment or something that is no longer being used to generate revenue. It's now being used for rental purposes, or it's being held for capital appreciation. So sometimes companies will move into a different building, right? So remember, we're constructing a building, we moved in, and we don't want to sell the building, the old building yet, because the market's down, for example, so we decide to rent it. So that becomes an IAS 40, not a PP&E, right? PP&E is IAS 16, this is IAS 40, okay? And the reason why it has to be reclassed is because it doesn't support the revenue generating activity, right? This is all about incidental revenue. In this case, you've got two options, you guys. You can use fair value approach. So let me do that here, okay? You can use option 1 is the fair value, and option 2 is the cost method. So there are these two approaches. This is subsequent to the reclass, okay? From IAS 16 to IAS 40. Okay? So let's say we happen to be we're in an old building, and then we decided that we're gonna move to a new building that we finished constructing, right? Much better, more efficient, ergonomic, blah, 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 all of those wonderful reasons. What do we do with the old building? If we're gonna rent it to somebody else, then we have to switch to IAS 40. IAS 40 says, if you do, you got two options. You can use fair value model. That means you have to fair value every year, up or down, or you use the cost model. It just means that we're gonna reclass it out of PP&E into investment property. Do you remember when we talked about the balance sheet, you guys? There's 5 sections. On the asset side, there's current asset, there's long-term investment, PP&E, intangible, and other. All right? So it can't be part of PP&E anymore because it's not part of revenue producing activity, right? The main reason it's only recording revenue in incidental because that's rental revenue. Or we hold on to it because we think it's gonna go up in value next year. So if you use fair value, you're gonna fair value the asset every year, no depreciation, okay? So fair value each year with gain or loss recorded as net income, not OCI, no depreciation, no impairment test. Why? Because it's already at fair value. If you do the cost method, you're gonna reclass out of PP&E to investment property at cost. Okay, that would be the carrying value, okay? You would continue to depreciate. And that means, you guys, you're gonna have to review the depreciation method, right? Because now the use of the asset is a little bit different than, let's say, the building used for the revenue generating activity, right? So this one here, you have to determine what is the new depreciation, useful life, the salvage value, etc. So continue to depreciate, reevaluate, useful life, residual value, depreciation method. And this one, you have to test for impairment. Okay? You gotta test that for impairment. So look what's happening to real estate today, right? Real estate's down, you guys. Commercial real estate's really not doing well. So if a company, let's say, has a research facility in Mississauga, decided to move into the newly constructed research facility in Newmarket, that research facility, the old one, will have to be evaluated, fair value, to determine whether there's an impairment test. Okay? So that's the two options. Now, this one here is the initial gain on fair value. So remember this, if the PP&E was originally at carrying value, so let's say we were using carrying value, and then we decide to apply the fair value model under ISA 40, the initial gain on the change from PP&E, that's the cost model, to IAS 40 goes to OCI. So that's another OCI effect, right? So far, what have we learned about OCI, you guys? The first one was investment, chapter 9, right? If we classified a passive investment as fair value through OCI, then any gain or loss goes into OCI and then AOCI. That's the first thing we learned last week. The second one we learned is this one. This is IAS 40. When you initially, right, reclassify a PP&E, ISA 16 to ISA 40, and you decide to use the fair value model, then the initial gain or loss goes to OCI. And then any subsequent gain or loss goes to regular income. That makes sense? Okay, so this is the subsequent, right? Fair value each year goes to regular income. Okay, that's your second OCI transaction. Okay? Natural resources, it's just basically anything you extract from the earth. Okay? And the thing that you gotta remember, you guys, is that it's gonna go as an asset, it's gonna be amortized, and it's gonna sit in inventory. That's essentially what it is, and from inventory to cost of goods sold when we eventually sell it. So think about, coal, diamond, copper, magnesium, anything that we extract from the earth, oil, right? That one there goes from natural resources. We're going to deplete it. We're going to depreciate the asset. That depletion amount goes to inventory, and inventory to cost of goods sold. Now, there are 4, activities when you're in the exploration and the extraction phase of a natural resource. So think about it for a minute, you guys, right? You bought a piece of land up north, and according to the scientists, there's a bunch of coppers or mineral in that land, right? So normally there's going to be those tests, right? Usually by a bunch of scientists, they'll give you a report that says, in the square meter, this is how much diamonds or copper or whatever it is that natural resources we can extract from, okay? So first you're gonna acquire the property, because the report tells us there's a bunch of really good stuff in there. Then you're gonna explore, okay? Then you're gonna develop, because once you explore, you realize the content of whatever you're extracting is of high number, then it's worth developing it and then restoring it. Restoring is once you've taken up all of the materials, the natural resources, then you want to, right, obviously restore the piece of land. Okay? So capitalization makes up the depletion base and depreciated over the life of the asset and into inventory. So you can see these are the 4 phases. There's a lot of money here. Okay? So those are the natural resources. Now, there's 2 approaches, you guys. One is called the full cost method, and the other one is the successful effort method. So successful effort method says we're gonna capitalize until we know for sure it's successful. If it's successful, that is when we continue to capitalize. If we don't think that it is successful, then we need to expense all of that. So the way it works is this. So let's say you bought a parcel of land. You're going to create what I call lot sizes, right? These are different places or different content of minerals that's in this particular section. So as we start to explore, we start to realize that maybe the scientists have overstated the amount of minerals in that lot. As soon as we know we're not going to explore, we're going to expense the entire section of that land. Otherwise, we would continue to capitalize if we feel that there's revenue that supports the amount of capitalization of that natural resource. The full cost method says we're going to just capitalize all of it, you guys, and then we're going to test for recoverability each year and each financial statement day. Okay? So that's the difference there. But remember, you guys, it's always a debit. Instead of depreciation or depletion expense, you're debiting inventory. And from inventory to cost of goods sold. Okay? Biological asset, this one here is IAS 41, and for ASPE it's 3041. Okay. So under ASPE it says, productive biological assets are held for use to produce and supply agricultural inventory, developed, acquired, or used in continual basis other than for short productive lives and not intended for sale in the normal course of business. Okay, so think about cattle, right, for milking cows. Okay, that would be an example of biological asset because it produces, right, inventory. And inventory is what we normally would sell in our dairy farm, and those cattle are normally not for sale, right? So again, normally when you're in a cattle farm, you have different kinds of, right, cattle, one for beef, one for milking, one for productivity, right? So all they do is they produce more cattle. So you got different, right, asset, and depending on what kind of asset, we're going to either capitalize and depreciate, or we call that as inventory. So obviously, if you have cattle that's for meat, you raise them, you slaughter them, and you make hamburger meats, whatever it is, that would be inventory. But if you have cattle that's going to bear more calves, right, then that would be PP&E, right? So now we're in a world where we have to classify, right, living animals as property, plant, and equipment. That's kind of the way we have to do it now. Measurement at cost, including cost of acquiring, developing, and bettering the asset, and of course subject to amortization. If it has limited life, assessed for impairment like PP&E. Okay, so just think about an apple tree, right? Apple tree bears apples that we would sell as part of our revenue. So those apple trees would have to be depreciated as PP&E. Okay. All right. Now, there's two kinds, you guys. There's called bearer plants, what I just explained to you with the apple trees, a bearer plant. You also have grapevines, rubber trees, etc. And you've got the fruit that it develops or creates. Those are called agricultural assets or livestock. Okay, or, right, obviously the fruit. Assets are measured initially, and then every financial statement date, the fair value less cost of sale, with changes to fair value going through net income. Okay, so here you got two options. You can either use the cost method or the fair value method, you guys. So this is the fair value, and you can also use the cost. Okay, and for the cost, it's the same thing as what I just showed you with investment property. You're gonna relabel those as biological asset or bearer plants, and then you're going to record, right, the cost, and you're going to depreciate that asset over its useful life. Okay. It says you can use the cost of revaluation model for bearer plants, and obviously the only way you would use the recoverable model is the fair value is readily available and extensive disclosure regarding sustainability. So now we're in the world where we've got multiple different measurement model for IFRS, but the good news is under ASPE, always the cost model. Okay? So we saw the fair value model called investment property, but you can see that PP&E, you can either have revaluation model or cost model. So let's take a look at the revaluation model next. So revaluation model is a way for us to measure PP&E at fair value without having to sell it. Okay, so let's say I have a land and building downtown Toronto. I bought 40 years ago. I paid $100 million. Now it's worth $600 million. On the balance sheet, under the cost model, you're not going to reflect $600 million. It's going to be sitting at $100 million less the depreciation. Unless we can apply this thing called the revaluation model. And it's only under IFRS. And it's only when fair value of the said asset are easily and reasonably determinable without additional cost. Right? So a good one would be real estate, right? Building, because you can find that fair value, right, of the building. Now, how do we do this, you guys? So the way it works is this, right? So I'm gonna skip this. I'm gonna show you an example, and I'm gonna come back to this so that it now makes sense. So here's an example. Oh, by the way, there are two methods. The one I'm gonna show you is this method here. It's called the asset adjustment method. This is the easier one, okay, simpler method. The other one, it's called like a proportionate reduction or appreciation method. This one here is we have to constantly remind ourselves that the asset has accumulated depreciation and cost, and we're going to adjust the fair value increment based on a prorated method between cost and accumulate. Because at the end of the day, we want to always let our stakeholders know that this asset has, right, accumulated depreciation of some sort. Okay? And that's going to be covered in your appendix. I'm not going to cover in the lecture slide. I'm going to cover the easier method. You're going to see that example in the next few slides. So here is a company. It has $100,000 cost of the building that they bought in 2021, and I made this really easy because 100 is easy, right? And they're going to do this revaluation every 3 years. Now, we're going to see in the slide somewhere that you're not supposed to do this every year. It's supposed to do the revaluation, the fair value, if we know there was a significant change in the marketplace. Okay, so obviously real estate, it's kind of weird, right? You know, we're in a world now where the real estate value has gone down. So this would be, if I was doing a revaluation model, this is when the company would actually do the fair value, right? And do the revaluation today. So here is the following information. Okay, you guys, we did the fair value, right? Once, the first one is 2023, and the next one is 2026. Okay, so the first revaluation model is 2023. So what we're going to do next is we're going to look at the carrying value of the asset before the revaluation, right? So remember, we bought it in 2021, and we've already depreciated the asset for 3 years up to and including December 31st, 2023. That's why you have an accum there of 12. Okay? Now, we said that the revaluation goes to 90,000. That's the fair value in, okay, 2023. So that means that I want to move this up by 2. I want to increase it by 2 because I want it to end up to the 90,000. Okay? So what do I need to do? The first thing I need to do is I'm going to close out the accum so that now I'm going to reduce the building's cost less the accumulative amortization. So now the building has a cost of 88. Then I'm gonna increase the building and the credit goes to OCI. So this is the third OCI transaction that you've learned so far. The first one is fair value through OCI investment. The second one is investment property, ISA40, the initial reclassification from PP&E to investment property. That initial bump up in fair value goes to OCI. This is the third one. Okay? So if you're fair valuing the equipment, in this case the building, it goes up by 2, the corresponding credit goes to OCI. Okay? Now, we're gonna depreciate the asset, and the depreciation this time is gonna be based on the $90,000 revaluation fair value. And the next fair value is not until 2026, which is 3 years later. Okay? So now you've got a net book value of 77,727 because you're depreciating the asset for no longer 25 years, it's now 22 years remaining. That's why you're dividing by 22. And then we are going to multiply by 3 years because that would be the depreciation. So the bad news is if you use this model, your depreciation is going to be higher than normal, right? Because it's based on fair value. Okay? So here's what's happening, you guys. When we look at the revaluation of fair value, it went to 75. So it went down by 2,727. The first step I'm going to do is close out the accum depreciation. By doing so, my carrying value of the building is now 77,727. Then I'm going to reduce it by 2,727 because I want it to be at fair value of 75. Now, what do I need to do? I need to first debit, if I've already built up some OCI from the revaluation model, I'm going to bring that down first. And then the difference goes to, right, some sort of loss that's going to hit the income statement and part of retained earnings. So in this case, I need to debit OCI. By doing so, OCI now, called revaluation surplus, is now 0. This cannot be a debit. So this account can only be a credit or 0. It cannot be a debit. So in this case, if I was to debit OCI, 2727, I only have 2,000 there. I can't do that, right? So I can only debit 2. And then the rest of it goes to regular income. Now, let's say 3 years from now, the value of the building goes up. Okay? Okay? And let's say I'm going to write it up by $3,000. Let's say I do one of these again 3 years later. Okay? So let's say I've got a write-up of $3,000. Now, what do I do first? I'm going to go and find out how much did my income, right, adjusted down because of the revaluation loss. Oh, that was 727. So I'm going to debit. So I'm going to credit revaluation gain 727. Okay? It's going to affect my net income, and the rest of them is going to go into OCI. So OCI can only be a credit or 0 balance. Does that make sense? Okay. So that is the example here, you guys. So let's go back in the slides. Let's read what it says. Okay? It says, PP&E assets revaluation is carried at fair value at the date of revaluation less any subsequent depreciation and impairment loss. That's exactly what we saw in that example, right? So we fair value and then we depreciate the asset until the next fair value. And you're not supposed to do the fair value every year unless there are circumstances that lead you to believe there's been a change, significant change in the fair value. Only available for those fair value that can measured reliably. So this one here, if it's difficult to measure, don't bother. Now, you can probably find out under IFRS 13. And there's this like 3 hierarchy. There are 3 levels of fair value. Okay? So they're saying that if you can determine the fair value really easily, then use this model. If it's hard, then don't use it. So you know how we said that revaluation model can be on, right, agricultural properties? Remember that, you guys, that comment there? Most likely not, because fair value is very difficult to assess, right? And intangible asset, which we're gonna see next, or hopefully next week, right? Our last class. That one is hard to find to determine the fair value, right? Because those are rights. So you rarely ever see revaluation model an intangible asset as well. Okay, because the value of an intangible asset, let's say a patent or a copyright, is essentially the revenue it's gonna generate. It's very hard to measure the fair value because there's no marketplace for, copyright. Unlike building, there is a marketplace, right? You can look at the real estate, right? You can look at the square, how much is the fair value of each square meter in downtown Toronto. That number always is heavily quoted, right? Okay, now it says revaluation must be frequent enough so that the carrying value is not materially different from the asset's fair value. Not necessarily every year. Okay, when the carrying value of the asset increases, that was our first example, then you credit the revaluation surplus unless the increase reverses the previously decline recognized into income. So remember my third example? Hey, let's say it went back up, then that increase, we're going to first hit the amount that impacted the retained earnings, and then the difference goes to OCI. If the carrying value of the asset decreases, that was our second example, then you debit revaluation surplus to the extent that they count for credit balance of the asset. So whatever is sitting there on a credit, that is the most we can debit. We can decrease. Otherwise, the debit is recognized as a decrease in income. So that's exactly what that 727 was. Okay? There can be no net increase in net income from revaluing it over its life. So remember, we credited it, and now we need to debit it again. So the net income will never be, you'll never make money unless you sold the building, right? That's the idea, okay? Revaluing surplus is transferred directly to retained earnings, either at each period or only at the time of disposal, okay? All right. And this is the 2 methods, right? And I like this method, and this is another option that you can introduce in CPA when you're doing case analysis, particularly if the covenant is based on total asset, for example. So let's say, company A borrowed money and the covenant is total asset, and they've got assets that are appreciating. You may want to recommend that the company should apply the revaluation model. Okay, and the impact as such. All right, any questions on that, you guys? Okay, so let's move on. Then you got the fair value model, okay? And this one is only for investment property, okay? And it says here, changes in value reported net income. That's exactly what I said in that slide here. No depreciating of the asset. And of course, you don't need to impairment test the asset because you're already putting in a fair value each year. Okay? Here's the example of the fair value model, you guys. So they've got a shopping mall, and a shopping mall is normally for rental purposes. Okay? Now, if you happen to be Cadillac Fairview, then those shopping malls that they own across the country is not investment property. Because that's their nature of the business, right? It's only when you are not in the rental business is where this becomes relevant, okay? In this case, you can see that the fair value changes over time, okay? And what do? Now, obviously, purchase price is added to the cost of the shopping mall. Property transfer fee is definitely, legal fees for sure. Now, empty store painting before renting, is that part of the asset or is that an expense?
Expense.
Why is it an expense?
It's depreciated.
It's because, why is this an expense, you guys? This is like if you were a Cadillac Fairview or a shopping mall, painting as soon as the client leaves and you fix the carpet, you paint the wall, that's part of repairs and maintenance. You're not making the asset better. It's not a betterment. It's not an extraordinary repair. It's just part of the normal course of renting. So just like your landlord, you guys, if you were to move into a building, right? Okay, so let's say it's a huge rental building. Okay, they have to paint it. They gotta fix the leaky faucet. They gotta fix the floor before they can rent it to the next tenant, right? So those are called repairs and maintenance. Okay, mortgage, assume financing, rest in cash. This one would be a liability. And tenant rent damage, that would be a liability. That would be called unearned revenue because that would be revenue earned at the end of the lease. Okay? So here you are, right? So this is kind of how the journal entry goes. Okay? And then guess what happens, you guys? Each year, we're gonna fair value this amount, goes up, you credit, a gain goes down, you debit a loss. In this case, right, the fair value is 1040, so you need to write it down by 3. Next year, the fair value goes down to 1028, so you're gonna write it down by 12. The following year, the property goes back up to 1040, then you're gonna credit a gain. Okay, and these are regular net income, right? These are income, right? Part of net income, all right? Now, there's a couple things I want to highlight, you guys. This is after we buy the asset, right? After, guess what happens, right? You either add to it, that's called addition, and again, remember, componentization, or you could, what we call replacement or overhaul, okay? That would be like taking a part from that equipment and then putting a new part to that equipment. Let's say a new motor, for example, okay? And then the other one is called rearrangement or reinstallation. This is the one where you moved it up to the second floor, you bought this $10 million equipment, you put it on the second floor, right? You're putting all the right enhancement to the building, a part of the equipment, and then all of a sudden you realize that maybe it should have been better on the first floor. So that's where you rearrange and reinstall, okay? Or just ordinary repairs. And repairs could be to keep it going, to keep it operating the way it should be. Right? So the difference between ordinary repairs versus extraordinary repairs is where you do something that's supposed to be to keep it going. Like, you know, if you drive a car, you change oil and filter to make the car operate the way it's meant to be. But if you start to enhance the engine or do something with the car that makes it go faster, more efficient on fuel, that is not ordinary repair now. That's a betterment. Okay? So these are 4 major types of acquisition or expenditure subsequent to the acquisition. Couple things to note, you guys, right? If you're doing replacement, overhaul, and inspection, the idea here is that when you bought the original asset, it would have already included, we would have capitalized installation costs. We would have capitalized, right, a bunch of these costs, right? The idea that if you're gonna move it to another part of the building or the second floor from the second floor to the first floor, the idea is that you're supposed to determine the original cost of the installation and the fees associated with putting it on the second floor. Okay? And then you're supposed to take it off, write it off, and then add the new installation or cost. If you do not have that number handy, okay, if it's not known, you must try to estimate. So a lot of times, a lot of companies that you buy equipment from, right, they'll give you one bill. They'll say it's $10 million and we will bring it in, we will install it, we will test it, and we're good to go. Kind of that's how it works, right? So you would never ever know how much of that $10 million price cost that you paid pertains to the installation and the testing. But our standard says, guess what? You're gonna try your best to estimate what that amount is, okay? If it's not known, estimate. If you really don't know and you can't estimate, just debit the asset, okay? But in this case, you would debit an expense because it can only have one installation. Do you understand? Right? That was IFRS. ASPE says, you know what? We're a little flexible. Try to do your best to estimate. But if you can't, I want you to take the cost of reinstalling the equipment, and instead of debiting the building or the equipment, you're going to debit a cum depreciation, credit cash. So that by doing so, you're increasing the net book value of the asset. Okay? So that's what ASPE says. All right? And these are some of the journal entries on that, you guys. I just wanted to highlight that for you. You guys can read that on your own. Okay? And there's a lot of great examples here. Okay? All right. Any other questions, you guys? So I just wanted to cover that piece from chapter 10, and I want to move on to chapter 11. Did you guys want a quick break? Okay, let's do a 5-minute break while I switch over to chapter 11.